Good morning, everyone. So I'm David Bounie. I'm a professor of economics at Télécom Paris, Institut Polytechnique de Paris, and so I'm very pleased to be here with you today. And so I would like to, first of all, to thank Merhy and Christian for inviting me to chair this session. And so I will skip the introduction because we are a bit late on the agenda. So, but so the objective of this session was to give concrete examples of different types of data that we can use. For instance, we talk about high-frequency transaction data that we use to nowcast GDP or macroeconomic indicators. And so I'm very pleased to welcome John Galbraith, who is a professor of economics at McGill University. And so we will talk about this in a couple of minutes, how we use this type of data to nowcast GDP or to tackle new research questions related to the spatial dimensions, for instance. And then I'm very pleased also to welcome Chafic Merhy, who is head of engineering and quantitative research at Ostrum Asset Management. So we have a researcher, John, and now we have a market player, Ostrum Asset Management, and then in this company also they use very diverse data for different purposes, and then I will ask questions to Shafi, and then and also some complicated, sophisticated models as the ones presented by Rama just here. And then I'm very happy to also to welcome Kheira BENHAMI, who is the chief economist at the Financial Market Authority. And then they also use a huge number of data to regulate the financial players, the market players on the market, and then there are also a lot of challenges that we want to also to discuss here. So thank you very much for participating to this roundtable. So my first question for you, John. So you use for a number of years now some data that we call high-frequency transaction data. In particular to nowcast GDP, but for various research questions. So can you just give us a concrete example of what type of data do you use, the specificity of this type of data, and also why do you use this data to, for instance, to nowcast GDP?
Now, I made up some slides, which means I've blown my cover and indicated that I received these questions in advance. So I don't know if David, you can call up the slides. Okay. Thanks, lovely. So the first, thank you. The first point I want to make is that one of the most important applications, I think, of data of this type, these high-frequency data, is to monitoring of the economy in general, to GDP, consumption, retail sales. But it's also one that doesn't use all of the capabilities that are in these data. So I think it's a very important one. It's perhaps an unusual circumstance in which you have to do less work for some of the most important applications. But these things have been used, these sorts of data aggregated to a very high level, have been used by central banks for some time. So I'm just going to give a simple example of, there we go, what the Bank of England has called, I think they still call some experimental data series extracted from debit and credit data in the UK. So they've reduced these now to, I think, 3 series, but they're still reporting. There were a couple of other subdivisions that I believe they've dropped. But the point here is simply that this is just an aggregation to a time series or a small set of time series that are going to be used with model types that we've used in other contexts. So these can be used with regression models, with mixed frequency MIDAS models, with neural network models. And the question, as was discussed yesterday, is what is the value added of these additional data? Do they improve our monitoring of the economy? And the answer seems to be that indeed they do. And of course, there's also the fact that these data are in principle available very, very rapidly, perhaps even the next business day. And they allow then daily, in principle, updating of this very important quantity, which is GDP or again, consumption in the economy. So it's a problem that's existed for a long time, that we try to make economic policy, but based on data which are typically, if we're waiting for the traditional government sources, they're old data. The GDP data will come out 6 to 8 weeks after the end of the quarter. They're old and they're infrequent and they have very little granularity. So even this aggregation to a few series seems to make quite a substantial improvement in the way that we can do the monitoring, but it still uses only a small fraction of the information content that is in some of these data series. So in a moment I'll give some other examples of some problems that use the data more fully.
Chafic, in a different context, you also use some mixed frequency data and also sophisticated models to manage the volatility of assets, etc. So can you also give us concrete examples of the data that you use and the models that you can use also to manage the volatility?
Yes, thank you, David. I'm very glad to take part of this panel today. I work for Ostrum Asset Management, which is an affiliate of Natixis Investment Management. So we manage a wide spectrum of strategy ranging from money markets to total returns, multi-asset class, fundamental and quantitative portfolio management, as well insurance. And intrinsically, one of the difference between those strategy is the investment management horizon. So for insurance company or for institutional, it will be a long-term horizon, while for, I would say, for other investors, it can be a shorter-term horizon. So it is of big importance how to mix, when you want to do some informed decision-making, how to mix information and data coming from different different frequencies at various spaces, and how to glean the relevant information and put it into your portfolio. And Midas can be a parsimonious approach where you can aggregate all this information in a simple and I would say even analytical way of aggregating this information and put it into your portfolio. Now, another application can be in terms of risk models also. So for many mutual funds, the risk budget, let's take for instance tracking errors or volatilities, are expressed per year. So you'll have, like, for instance, a 3-year or a 3% tracking error target or budget for per year. So, and at the same time, if you look at a lot of data providers and solution vendors for risk solution vendors, mainly due to the lack of data in order to computing annual risk, we'll compute it on a lower frequency and then we annualize it. So if you take, for instance, for a specific month and you have like a 3% risk or volatility, that will be perhaps 12% or 10% over a 1-year horizon. And the underlying assumption is that what we have witnessed in the last months, we will witness it for the coming 12 months. And that will lead to some stop loss and cutting of some positions that are not desirable, knowing that over longer horizons, fortunately for all of us, the risk will not get accumulated, but there's a kind of mean reversion. So Midas proof and mixed frequencies approaches may prove to be very useful in order to mitigate the lack of data and the horizon problems in a very parsimonious approach.
Thank you. Kheira, so we understood that the data is also at the heart of the mission of the regulator. So can you explain us a bit more about the type of data that you use. Also, you build a platform to manage the data. So can you give concrete examples?
Yes, so thank you also for having invited me to this interesting discussion. So as you know, the IMF is responsible for ensuring that investors, that savings that are invested in financial markets are protected. So what we do is that we make sure that investors have access to all the information, and we also supervise the operation so that we have orderly and, I would say, efficient markets. In doing so, we also take into account the financial stability dimension, which is something that is one of the last missions that have been added to the IMF. So to ensure these missions, so we have a wealth of information to base upon, and in particular, regular reporting. Most of you know what we are talking about. You are doing a lot of reporting to the regulator. And it has been greatly enriched over the past years. So at the beginning, we began with the transaction reporting on equities and bonds, and then it has increased a lot. So we had access to OTC derivatives with the EMIR data and data coming from CCPs and CSDs. And more recently, we have also access to securities financing transactions. So this is on the transacting part, but you also have lots of data on the asset management part. You have some reporting on for example, the AFMD reporting, the MMF reporting. So we have access to a huge amount of data. So to give you an idea of how the data volume has grown. So in 2003, which is the beginning of the IMF, we received something like 650 million reports. So it was transaction and orders. So in 2022, the number of reports that we received is now at 175 billion reports. So you see that it has grown a lot. And despite the fact that we have a lot of data, there are also some information that we don't have. And we try also to rely on public information to complete the information that we have. So it can be the press, it can be the internet, the social networks. All of this data helps us in our missions. And we analyze it. So what is the use? The main use, the market surveillance part. So what we do is that we constantly analyze the market activity and the transaction. The idea here is to detect any behavior or situation that might undermine the integrity of markets and or the smooth operation of the markets. So this may include, for example, any case of price manipulation, insider trading, dissemination of false information, and more broadly, any breaches of obligation that have to be fulfilled by market participants. And of course, as an economist, I'm also very happy to work at the IMF because I have access to lots of data to make the analysis. So this is one of the big advantages as being an economist at the IMF. And more particularly, so we publish regularly some studies that help us understand how markets are evolving, but also to identify the new era of risks. And this is in connection with the financial stability mission that we have also. So the idea is to spot signs of financial deterioration or try to intervene as quickly as possible as a regulator when we see something spreading. So to make use of this data, we have made a lot of investments, and we have set up a big platform data. You might have heard about 𝐅𝐢𝐧𝐚𝐧𝐬𝐤, it is the name of the platform, which has been operational since 2017. So this has been a big game changer in the data processing, given the volumes of data that we receive. So it enables us to store and manipulate this information with greater performance and speed of processing that we were not able to reach before getting to these technologies. And lastly, we are also trying to rely more and more, like any market participant, on the potentialities that artificial intelligence gives us to support the team in their core missions. But this is something that we will discuss later.
Thank you. John, just to come back on the high-frequency transaction data, so we know that we have some issues to tackle some research questions related to the geographical issue, the topics and etc. So can you just give us also some concrete examples on how you use this type of data to tackle some special topics?
Thank you. And let me point out that I'm going to describe some joint work with David and also with Youssouf Kamara, who I think could not be here today. So I suggested a little while ago that one of the most important applications, I think, one of the most interesting applications of these very large data sets is in a simple aggregation to the daily level, which allows us to speed up monitoring and improve the accuracy of monitoring. But these data sets differ a lot in their content. Some of them contain information that allows you to geolocate transactions. Some data sets do not. Some data sets pass through payments clearers so that you only find out that a transaction took place in a given day. All transactions may clear, for example, between midnight and 3 o'clock in the morning, and you just know that it took place on the previous day. Other data sets give you a precise timestamp and the information necessary to geolocate a transaction, possibly a distinction between online and in-person transactions, and possibly sectors of the economy, which allow in principle monitoring, for example, of different retail sectors, if that's something that interests you. So one of the most important of those applications, which impose the more strict requirements on the data set, is related to some of the things that were discussed in a very interesting session yesterday on climate risk, and that is extreme event studies using some of the geolocatable data. The point I want to make in contrast to the presentations yesterday is that we are monitoring flow losses here, or we're trying to track flow losses. So a number of presentations yesterday tracked capital losses that arise from extreme events. Obviously, that's extremely important and interesting, and insurance company data give us bounds on those losses often. And there are a number of things that we can determine in studying those losses. We have relatively little information about the flow change in economic activity when an extreme event takes place. There may, for example, be even a heavy rainstorm which doesn't impose any capital losses on anyone. Your roof might leak, but in general, nothing much. But there may be a substantial reduction for a short period of time in economic activity, and there's very little information in economics about what those changes are in economic activity over a short period of time. So with finely geolocated data, it becomes possible to take a very small area, for example, in central Paris, and a very restricted time period, and look at the degree to which there's a change in the flow of economic activity over that period, even if the capital account changes are very small. So here's just an example from some recent events in France, since the data that we're working with are from the Groupement de Cartes Bancaires CB, and these are the kinds of data that I'm speaking about that involve these finely detailed bits of information that allow us to characterize a location. So here's just an example of something that can be tracked as a change in the flow of economic activity. So on the left we have a picture of a tiny little, I'm going to have to get up to describe this, I guess. This corresponds to this tiny little area here in the corner. This picture roughly corresponds to that. So it's an area, Teste de Bûche, which is, I am told by those who know better, an important tourist area in France, very attractive coastline and so on. And you can see that there were fires burning at this time. What degree of capital loss there was, I don't know, but clearly it's less attractive to be in the area at this time when there's a lot of smoke in the air. So on the right, we have, for a number of the communes within the département of Gironde, we have the flow change in economic activity over this period. So again, just to return to this little area here, there was a reduction that we measured over this period of about 20%, well, greater than 20% in economic activity. So it becomes possible to look at the effects of extreme events over really quite small geographical areas within the scope of this photograph. It becomes possible also to treat events such as floods, where unlike a fire, for example, where the effect is reasonably widespread within a certain area, if you have a flood, you may have devastating consequences on one side of the street and nothing on the other side of the street. So you need very finely detailed data in order to be able to distinguish areas within a general flood zone which were affected or are unaffected. So I think these are extremely interesting applications. There are all sorts of other things that one can do as well. We can look at nowcasting for regions of a country about which there is relatively little information in official data, distinguish on-site and online activity. And another thing which I hope we're going to be able to pursue in more detail in the next little while is to look at consumer mobility using these data, because whenever a transaction is made, one has a location for the transaction, and that can be traced to a particular card. And that can be compared with information that arises from cell phone data in principle, and different, of course, types of information can arise from these things because they measure consumer location in different ways. But I think it will be an interesting comparison. So there's just a lot of information content in some of these data sets that allows us to pursue new questions which it has not been possible to address with the relatively heavily aggregated national accounts data that we've had.
Thank you. Thank you, John. Kheira, so you told us that you have a lot of data, you have a platform, and now you use also some new techniques to extract information from these data sets. So I noted that you used some deep learning methods for the analysis of risk factors. For instance, so can you describe a bit what you
this
are
is
doing?
part of the what we call the IC data program. So the idea is to exploit data more intensively. When I talked about more and more reporting, we also have more and more reporting that are, I would say, less structured. With a transaction report, you have some data files, and it's simple to analyze as any numerical, I would say, data. But more and more information now is coming into PDFs, where you don't have structured data, and you have to be able to have access to this information to be able to monitor the markets and so on. So we have developed this IC data program to exploit more intensively the data. And the experiment that you are talking about is an initial one which result was published last January, I guess, last year. So it explored indeed the potential offered by one of the branches of the artificial intelligence, which is the natural language processing, which is really one technology on which we based a lot of our analysis. So to give you some element of context, since 2019, the European regulation has laid down a new format of requirements for the presentation of risk factors. So it has constrained both the form and the order of the presentation. So before any automated exploitation, this analysis was made manually. So you can imagine the time that you can spend in looking at this information. And it was long and tedious. So we have something like several hundred of documents that we have to have a look at, given the number of issuers that we have in the French market. So and the difficulty of automatically reading this type of content has been bypassed by the recent advance in deep learning techniques. So what we have done is that we have developed an automated tool, so in-house, for the risk factor analysis. So it includes both artificial intelligence techniques to extract the information from the text, but also to set some appropriate displays of the extraction results to make the exploitation more easiest to support the word carried by the AMF teams. So what we've done is that, as I told you, we based our analysis on more than 100 of financial universal registration documents, so URD. And what this experiment have shown is that it is possible indeed to automatically assess the breakdown of the risk sectors by issuers, to monitor their change over time, but also to detect the most significant variations that we observe from year to year for each risk described. So it has really decreased the burden of the analysis, but also expanded the level of the possible information that we had access on compared to the manual approach. So this means that this first experiment really suggests us to go more intensively in the use of this type of methodology. And maybe it has also stressed out the fact that this also works if we assume that the regulated players use machine-readable formats. So this is something that is really important. So it requires to follow the good practices, to improve the quality of the documents, and use the appropriate techniques for us to be able to read these documents.
Thank you. Chafic, you also use some what you call extra financial data to, I don't know, for different purposes. So you would like also to discuss a bit of this type of data and the application of the.
Yes, sure. One of the most important part in active management is forecasting of returns, but also of risk. We have developed a lot of internal proprietary models in order to help us to get informed decision-making strategies. So one of them is based, among else, on some extra financial data that can be made possible also by the use of some machine learning techniques. So the idea first was how to project the risk for sovereigns in terms of rating or for instance. And if you look at standard approach, it will be more or less some scores, which means a kind of weighted average, which means that you have a marginal rate of substitution between covariates, which leads to, if you have an improvement in a specific covariate, then it can offset the decrease of another covariate. We do not share this this vision in the sense that it does not acknowledge the nonlinear dynamics of risk, and sometimes you have jumps and some nonlinear developments that preclude such compensating effects, and we have to cope with. So first, we began by using some classical financial economical data, as I mentioned, and we found that it can be also useful to have a holistic approach and to rely on some material extra financial data. So that was the first part. Now, one of the difficulties is how to put them all together in specific models that will help you to glean the relevant information in terms of forecast. So we have tested a lot of approaches, from the simple ones, more complex ones, and by the end of the day, we had to do like kind of choice, compromise between parsimony, the precision of the estimation and the forecast of the risk factors, and so we went into some some what we call machine learning techniques, and one of the drawdowns is they are most of the time black boxes. So we had to do a lot of, if we want portfolio managers and investment decisions making to use those models, we have to make them less black boxes. So we have done a lot of works on the interpretability of models. For instance, what will happen in kind of scenario analysis or sensitivity analysis to the models, what will happen or what kind of data will make the model shift its estimation from A to B, from B to C. And that was very helpful for the users of the model to learn precisely what are the bias of the model. Now, another interesting feature is that when you do forecast, it's an expectation. So it's one figure. So one of the things we worked on is that instead of working on one feature, on one figure, is to project the whole distribution and to give also the expectation. That could prove to be very useful when you have some alternative scenarios. So you can say, we are seeing on average some improvement for this entity. However, there is a significant risk of of a negative scenario or a positive one, and vice versa. And last but not least, we also found that in addition to traditional economical and financial data, the use of some extra financial one proved to be useful in helping in our understanding of the risk dynamics and the accuracy of our estimates.
Thank you. And the last question before opening the question to the audience, Kheira. So can you give us also some other concrete examples on because you have a lot of data, you use more and more machine and deep learning methods, so you have a lot of applications. So can you give us some concrete examples?
Yes, following this first experience that I talked about, we also developed some other tools internally. So for example, in the field of investor protection, so we use web scraping techniques also to, and NLP also to identify potentially fraudulent financial sites in the mass of the website. So you imagine that this is something that is very, I would say, efficient in terms of application and the way we can monitor the market. So we have developed once again an in-house application, so that scans around 2,000 websites and detects concretely potentially fraudulent sites on keyword analysis and try to classify also the sites. Another field of application is also with the reporting obligations. So for example, when you talk about threshold crossing declaration, we try to monitor aggressive or hidden capital increase, for example. So this was something that we received, that we had to look at manually. And now, once again, we have developed a process to analyze this declaration and to be able to monitor how this capital increase goes. So once again, to give you some data, every year we receive 1,200 declarations, so of major shareholder in their listing companies. So once again, we had to process them one by one, and now it's easier. So tasks can be carried out more quickly, and also with less risk of errors. In fact, so it is something that is really good and a better time allocation than having a look at PDF. So more generally, we continue to implement this data and AI strategy. So we focus on 3 key objectives. So the idea first is to make the data shared both internally and where possible externally, so with the open data program. To automate data and information processing. Each time the AI enables us to use this type of capacity, and to develop once again some tools to extract additional values from the data that we have, and to help detect individual or even global risk. So we are particularly focusing our efforts on the investor protection side, of course, and developing innovation within institutions, and also all that is going on in the field of sustainable finance. So we are using these techniques to get access to the risk, but also in terms also of costs also. So this is something that we have a look at, and we hope to make interesting studies based on this analysis.
Thank you very much. Maybe if you have questions in the audience, yeah, Merhy?
So thank you, great panel discussion. I enjoyed it a lot. I have a question related to also yesterday's presentation, because we learned from Thierry Foucault that satellite imagery, and in particular these parking lots photos that you can make, have a lot of value for quantitative investment strategies. And then I have a question to you, because I know you've been working, John and David, on this kind of data. I guess it's not allowed for hedge fund or portfolio managers to use your transaction data, but as a research purpose, did you try? Because you have much more granular information, right? So much more precise than just the photos of the parking lots. So did you try that as an investment signal? And what's...
Well, I suppose... my answer would be that it depends upon what the investor is trying to track. I mean, I think that tracking GNP numbers, consumption, retail sales in general is important for forecasting performance in some industries at least, and for making asset allocation decisions, for example, between different types of retail organizations. But there's a finer level that we haven't moved to that I think, again, for sectoral analysts with particular interests, it could be of value. So I can imagine, for example, that if you're a retail sector analyst, the data sets that are sufficiently fine to allow you to distinguish, for example, sporting goods from appliances, from information services, computer equipment, things of this type, clothing, which these data sets do in some cases, could allow you to make asset allocation decisions between different parts of a retail sector. I can imagine it informing investment decisions with respect to which of these subsectors of the retail sector could be the most promising one in coming months or years. So it's within a relatively limited sphere of the economy because we're dealing with consumer transactions. So the applications that I would think of would be to retail sector analysts. I'm sure others will think of other applications, but there I think there are certainly opportunities for exploiting information of this type to make calls between different sectors.
Yes.
Thank you very much. Question for Mr. Merhy. So you mentioned that currently you leverage machine learning and AI capabilities in a number of business areas. So with the insight that you have at the moment, where do you see the most value that has been brought by those processes, and where do you see those applications in other areas that currently don't leverage it, where you could see potential opportunities?
Yes, thank you for the question. It happens to be, I'll give you a scoop, a couple of weeks ago I was at ICMA with Merhy, and we'll ask you to read one of the last publications of Merhy on that subject. But I'll give you my lecture on it. The way I see it is that you have two kinds of application and value added you can glean from it. First is efficiency. As mentioned by Kheira, before, when you had like PDFs or reports, you have to read it, and then you have to analyze it, and then you have to make your own opinion based on it. Today, those three aspects can be fully automatized. So with sentiment analysis, with NLPs, with all that. Second, also with respect of the efficiency, I would say, part of view is that with the generative AI, you can generate reports, you can generate for clients, you can, I would say, at least do 30 to 50% of the work. Even for quants, IT guys, you can generate kind of codes that can be very helpful. They won't answer 100% of the job, but you won't have like this blank page. For marketing purposes, with Copilot, with other solutions that are widely spread currently, you just put a couple of items and then you have all the presentation. That's a lot of gain in terms of time. And then I would say you will have, for investment purposes, the use of those alternative data. So as also mentioned by my colleagues, data was structured when perhaps a couple of decades data was a matrix, just mainly quantitative, sometimes it can be qualitative, but it was structured data. Now you have sensors, you have satellites, as mentioned, you have PDFs, you have videos, you have pictures, you have a lot of data. And the interesting part is how to glean relevant information for your investment process. So by the end of the day, if somebody said that like decades, finance is just in a certain way, if you want to do alpha, you need to identify when prices are low to buy and when prices are likely to be high to sell. So this can help you also to have information more rapidly and to extract new scope of data to which we didn't have access before.
Thank you. Another question? No? Okay, so thank you very much, John, Kheira, and Frederic.